Stocks and bonds. You've heard these words a million times, right? They're kind of the two basic building blocks of the entire financial world. But here's the thing. One is all about owning a piece of the action, and the other is about loaning your money out. So what's the real difference? And more importantly, how do you figure out which one makes sense for you? Let's get into it.
All right, here's the game plan. We're going to start with a super simple story. Then we'll actually define what bonds and stocks are. No jargon, I promise. After that, we'll put them in the ring head to head to really see the pros and cons. And finally, the most important part, we'll connect it all back to your money, your future.
Okay, so to make this whole thing crystal clear, let's forget about Wall Street for a second. Let's imagine we're starting a business together. A classic, simple lemonade stand.
So picture this. You've got this amazing top-secret lemonade recipe. It's going to be huge, but you need some cash to get started, right? For the lemons, the sugar, a really cool sign, all that stuff. Basically, you need to raise some capital. So, the big question is, how do you get that money?
When you boil it all down, you've really only got two basic choices. You can go out and borrow the money, promising to pay it back, or you can sell off a piece of your new business. And believe it or not, right there in that simple choice, you've just stumbled upon the fundamental difference between bonds and stocks.
All right, let's explore path number one. You decide to borrow the cash. This, my friends, is the world of bonds. In this scenario, you're the borrower, and the person giving you money, they're the lender.
So what exactly is a bond? Well, honestly, it's just a loan. That's it. When you buy a bond, you are literally lending your money to a company or even the government. And in return for that loan, they make a promise, a legal promise, to pay you back the full amount down the road, plus these regular little payments along the way called interest. Just think of it like a really official IOU.
And that's really the whole idea in a nutshell. Going to someone and saying, hey, I'm starting a lemonade stand, can you give me some money to get it going, and I'll pay you interest on it. Well, that's pretty much what a bond is. You're simply the lender.
And you see this happening everywhere, all the time. Governments issue bonds to pay for, everything from building new schools to funding huge projects. Think war bonds. And big corporations like Apple, they use bonds all the time to raise money for growth. Why? Because sometimes borrowing money is just way faster than waiting to earn it.
Okay, so that was the lender path, but what about that other option? What if, instead of borrowing, you decide you don't want a lender, you want a partner? Well, welcome to the world of stocks.
Now, a stock, which is also called equity, is completely different. It is not a loan, it's ownership. When you buy a share of stock, you are buying a tiny, tiny piece of that company. You become a part owner, and you have a claim on everything the company owns and hopefully everything it earns.
Exactly. Going back to our lemonade stand, you're not promising to pay the money back. No, you're selling a slice of the business itself. Your investor is now your partner. And if you've ever seen the show Shark Tank, well, that's exactly what's happening on screen. Entrepreneurs are trading away ownership, equity, in their company for cold, hard cash.
So this is the really crucial thing to remember. With a stock, you have skin in the game. Your success is tied directly to the company's success. You're not just a lender waiting for your interest payment. You're a partner hoping that the entire pie gets a whole lot bigger.
Okay, so lender or partner? Bondholder or stockholder? Let's put these two ideas side by side and see what really happens when things go amazing and when they go totally wrong.
And this really is the million-dollar question, isn't it? If your little lemonade stand becomes a massive nationwide franchise, who gets crazy rich? On the flip side, if the whole thing goes belly up, who loses their shirt? The answers to these questions get right to the heart of risk versus reward.
In this slide, this lays it all out. It's the fundamental trade-off. As a stockholder, an owner, your potential for growth is theoretically unlimited. If the company becomes the next big thing, the value of your shares could skyrocket. But the risk is way higher. If the company fails, you're the absolute last in line to get paid, and you could easily lose your entire investment. Now, the bondholder, they're the exact opposite. Their reward is capped, they're only ever going to get the interest they were promised, but their risk is so much lower. They have a legal right to be repaid, and if the business goes under, they're first in line to get whatever's left.
And this is literally the pecking order when a company goes bankrupt. Any cash that's left over gets paid out in a very strict order. Who's first in line? The lenders, the bondholders. They get paid first. Then, maybe, preferred stockholders. They're a special kind of owner. And who's dead last? The common stockholders, the regular owners like you and me. They only get what's left over, if there's anything left at all, which, spoiler, there usually isn't. And that right there is why bonds are considered so much safer than stocks.
Okay, that's all great in theory. Lemonade stands and bankruptcy, but why does any of this actually matter to you? Well, because this fundamental difference has a huge impact on how you should be thinking about your own money.
Yeah, this isn't just some boring textbook concept. This stuff affects your retirement savings, your 401k, your financial planning. It even affects how you make sense of the news you see every day. This core relationship between risk and reward, between owning and lending, it's pretty much at the heart of all of it.
And this chart shows a super common financial strategy. Look, when you're young, say 25, the advice is usually to lean heavily into stocks. Why? Because you've got decades ahead of you. You have time to ride out the market's ups and downs, so you can take on more risk and aim for that higher growth that comes with being an owner. But as you get closer to retirement, you start to pivot. You slowly shift more of your money into safer investments like bonds. You're trying to protect the nest egg you've built because you just can't afford a huge loss right before you need to start living off that money.
So that really leaves us with one final thought to chew on. Understanding stocks versus bonds is really about understanding two totally different mindsets. When it comes to your money, do you think more like a lender, looking for that steady, predictable return? Or are you an owner at heart, aiming for that higher growth potential even if it comes with higher risk? The answer to that question really shapes your entire financial journey.